Good morning and welcome to the BDO Economic Update for Financial Services. My name is Lee Tracy. I'm a banking partner at BDO and lead our financial services advisory practice. It's my great pleasure to introduce our session this morning. Following last year's unprecedented pandemic-related collapse, the global economy has experienced an exceptionally strong but uneven recovery. While advanced economies are rebounding, many of the world's poorest countries are being left behind, and much remains to be done to reverse the pandemic's staggering human and economic cost. Moreover, the recovery is not assured. The possibility remains that additional COVID-19 waves, mutant variants, vaccination delays, mounting debt levels, or rising inflationary pressures deliver setbacks. The near-term resumption of growth cannot make up for the misery that the pandemic has inflicted on the poorest and its disproportionate impact on vulnerable groups, including women, school-aged children, the informal sector, unskilled workers, and this has widened inequality. How national governments respond, the private sector, international institutions, to the challenges of poverty, inequality, and climate change as we emerge from this crisis that has affected us all will be the defining choice of our age. In this context, I'm delighted to introduce you to Sagar Saha, one of BDO's economists, who is also a respected member of our regulatory team. Dr. Sagar Saha has over 15 years of economic modelling experience, both as an academic and as a practitioner. His core area of expertise revolves around the development and application of computable general equilibrium models. That's a mouthful. I did practice that earlier, but didn't quite get it right. And other related classes of applied general equilibrium models to economic policymaking at a macro and micro level and macroeconomic forecasting. Sagar has substantial experience in the insurance and banking industries, applying his modelling expertise in the quantification of risk and capital under both Basel III and Solvency II. Over the next 40 minutes or so, Sagar will take us through the global and UK economic outlook over the near and medium term, looking at both the drivers of growth and the key risks to achieving a sustainable recovery following the pandemic. Sagar, I'm delighted to hand over to you.
Hello, everyone. Good morning in this wet London weather today. Let me start off by just setting out what we're going to cover today. So we're going to start off by looking through what the current prospects of the global economy is and what are the risks that might impact the global outlook, the global economic outlook, and just kind of consider them one by one and see which ones are probably slightly more relevant than others. We'll also look at the UK economy and have a quick browse through the indicators, the key economic variables within the UK economy, and also look at the risk of to financial stability and what could be impacting financial stability in the short to medium term itself, indicated by the key variables. Next slide, please, Laura. So we start off with the global economy. I thought it would be a good place to start if we kind of look at what the generalized theme is that's coming out of some of these projections that we are seeing in the markets at the moment. The overarching message that seems to be coming out is that it is a strong recovery that's coming through the high frequency numbers, but it's an uneven recovery, and it's very uncertain at the moment itself. It's primarily seems to be a race between the vaccine and the virus at the moment, and that kind of bears out in the projections for the different groups of countries. If you take a look at that, the middle diagram over there, the graphic, it clearly suggests that the advanced economies are, the forecasts have been revalued since the January forecast itself. The April forecasts have all been revalued for advanced economies, and they are going to be faring a lot better than some of the developing economies. And this has significant consequences for global growth itself, because if you start thinking about higher inequality, that is going to stem out of this divergence. Poverty in poorer economies and the low income countries, the health outcomes. One of the documented effects of below trend growth is health outcomes, in health and educational outcomes in low income countries itself. It has been studied, and there are a wide range of economic studies which suggest that for every 4.5–5% drop in your trend GDP over your long-term trend GDP, you're looking at least 10 years of poorer health outcomes, and that has severe consequences for the convergence in the global economy terms itself. But it also, if we look at the unevenness, it's not just actually focused on countries and groups of countries. It's also looking at the individual sectors. And if you have a look at the sectoral graph over there on the left, you can see that industrial production and manufacturing production has kind of pretty much bounced back to the pre-pandemic levels, whereas services has still a lot to go, and that is probably borne out because the nature of the services itself is a high contact industry itself, and that kind of leads to that uncertainty and the dampness in the prospects of growth itself. But even with services, if you look at the different aspects of services itself, trade services and say financial services, business services, all of these kind of services have actually bounced back and haven't had a pronounced trough. But if you look at high contact services like restaurants and so on and so forth, that sectoral divergence kind of flows through in the data itself as well. Effectively, you're looking at if you look at the right-hand graph, it kind of clearly states that it clearly shows that the world economy, the growth, the recovery is being fueled by advanced economies, and that has to be considered. So we have to kind of look at what we can do as policymakers to actually speed up the recoveries in the low income and the emerging economies itself. Next slide, please, Lauren. So the medium-term growth forecast, again, as I said, was completely kind of driven by the expectancy of the vaccines in each of these countries itself. So the advanced economies as a group, the estimated COVID cases, are roughly lower, but the vaccine, the percentage of the population that has been vaccinated is a lot higher, driving that uncertainty down to a great extent. Whereas with the low income countries and the emerging markets, since the vaccine the population, the percentage of the population hasn't been vaccinated to the extent that that would be desirable, you're looking at a lot of uncertainty in the recovery over there. Hence, that kind of flows through in the projections itself. So the right-hand slide kind of tells you what countries are above the median in terms of vaccination and which countries are below median in terms of vaccination, comparable with the kind of the recovery forecasts that are coming through in the current high frequency data that we are modeling. Next slide, please, Lauren. So let's look at some of these, some of the underlying features itself and the key economic variables. So I thought we'll start off with inflation, because that's one of the key risks that that you can have to your short-term recovery and short and medium-term recovery itself. And as you can see, that inflationary expectations and inflations is actually picking up across the globe. Now, whether or not these are actually structural inflation numbers, that is debatable, because all indicators are that the inflation bounding back at the moment is being spurred on or triggered by a lot of pent-up demand in advanced economies, as well as some supply chain issues that are coming through in terms of manufacturing, industrial production, but also driven by some shipping and freight issues, and that's been manifested over the last quarter or so with the Suez Canal disruptions, and some of the disruptions that are actually taking place in the container industry and so on, so forth. It seems like there is it is a temporary phenomenon, and as the pandemic starts to whittle down, and as economies start to recover, it seems like the long-term inflation expectations remain broadly unchanged at the moment. It's interesting to know that for this particular crisis, the inflation decline was a lot more muted than after the global financial crisis itself, and it was also more short-lived, and it was more V-shaped in terms of the drop in inflation itself. And there has been a faster recovery because primarily spurred on by advanced economies, but also by the demand that's coming out of some of the developing economies as well, especially China and emerging markets and developing economies, especially China itself. Next slide, please, Lauren. It's very important that we look at some of the sectoral insights as well, because as I said, the initial feature was that there is a clear divergence in between sectors. So what I thought I'd do in this slide is kind of look at the numbers for what we classify as high contact sectors and low contact sectors. High contact sectors that are affected significantly by the pandemic are things like, obviously, travel industries, the restaurant and hospitality industries, and so on and so forth. High contact industries which are less so affected are things like financial services, business, construction. Some of these are slightly less affected as it comes through from the numbers itself, the high frequency numbers that we are studying itself. Whereas low contact industries, more like, manufacturing, any sort of industrial production and so on and so forth, are low contact industries that have not been as severely affected by the pandemic as some of these high contact industries itself. And in terms of the tourism and the hospitality industry, those numbers for the low contact affected industries, they shows that there's still a long way to go before they can get back to the pre-pandemic levels. And a lot of it would depend on confidence, and that confidence would come from primarily the vaccination rates of these individual countries itself, that can then start opening up on a more sustainable footing than than having to open up and close periodically. Also, if you look at the consumption patterns as well, clearly the durable goods are the ones that have been least affected by this resurgence itself, and by the pandemic, and is the strongest sector in the resurgence itself as well. So I think what's happened is a lot of people within the global economy, as a result of either working from home or kind of, being given a lot of, funding from their governments and support from the governments, income support from the governments itself, have been, kind of upscaling their homes, buying more houses, buying durable goods for their houses, and so on and so forth. So that has kind of caused the durable goods to maintain the level of, the level of growth that it has. Whereas high contact services, like I said, things like tourism, things like hotels and restaurants have been very low in terms of demand, coming through, both in the pre-pandemic, both throughout the pandemic and now in terms of the recovery itself. It's pretty much flatlined. And the only way, like I said, the demand's going to go up is if there is confidence in the markets that effectively the vaccination rates across the globe are going up, and tourism and hospitality can open up with a fair degree of confidence itself. If we look at the sectoral price changes, and that right-hand graph kind of looks at the kernel density of the sectoral price change, there hasn't been a huge amount of, price allocation changes within the different sectors itself. Although you can see that the divergence within the, the high contact sectors is a lot more in terms of the price divergence as opposed to the some of the low contact services itself. So that kind of tells you that obviously because of these sectors being affected, there's also underlying connotations in terms of employment in these sectors that have been affected, and so on and so forth, and whether or not some of these sectors would be able to bounce back with the volumes that we had seen in the pre-pandemic levels, because a lot of them have actually gone out of business as a result of not being able to sustain the losses over the short to medium term period. Next slide, please, Laura. Global trade. Global trade's recovering. It's clear in the data. It's spurred on by that durables demand, and to a certain extent non-durables as well, things like retail, food, grocery prices. Commodity prices have actually been quite resilient throughout the recovery period from from Q4 2020 all the way to Q2 2021. But what's happening is that since there's a lot of demand for the high intensity durables that kind of contribute greatly to international trade, the low intensity, low trade domestic services, you have to look at what happens to that as the economies open up. So there is a possibility that as economies open up, the domestic services the services sector picking up might have an impact on the growth of the durable sector and the high intensity trade sector. So we are predicting the trade's going to slightly dip in the latter half of this particular year, because the domestic services sector is going to take up a lot of pent up demand as economies start opening up. But it's not a huge dip that we're predicting, probably a couple of percentage points for global trade itself. At the moment, manufacturing trade is being constrained by supply bottlenecks, but that is a temporary phenomenon. And as the economies start opening up and the pandemic starts normalizing, we think that those bottlenecks are going to be normalized, and the localized shortages of containers and the shipping freight issues are going to go back to their normal levels. I mean, clearly, if you look at that middle chart, the container shipping rate has just the freight rates have gone through the roof in during the last 6 months, and that's contributed a great deal to increased prices as well across the global economies. The increased freight prices have actually filtered in through the commodity prices and so on and so forth, and that has had an impact on the short term inflation rates that we were talking about. Some of the components of services are showing pickup. Services like trade, telecommunications, trade and telecommunications, financial services have been quite robust throughout this period because, again, they are classified as low contact. But anything to do with hospitality sectors and restaurants and so on and so forth have suffered hugely in this particular pandemic. And it seems like there isn't and a light at the end of the tunnel for a lot of these sectors in a lot of these countries itself, because tourism is expected to remain weak throughout throughout 2021 and probably till the half year 2022, till more countries get vaccinated to the levels that are desirable. Next slide, please. No. So what's going on with global finance? What are the prospects and the outlook for global finance? There's an unprecedented amount of action that's gone into the global finance. The amount of accommodative policies, monetary policies that have been run by the Fed and all of these central banks are unparalleled. On top of that, you've been looking at a huge amount of fiscal support as well coming through that has been filtering through into the asset prices within the global economy itself. Effectively, if you look at the 10-year emerging markets and developing economy bond deals, they are clearly rising from their January levels, and that's been spurred on to a great extent by the increase in the confidence levels that are coming through, filtering through from the US. The US 10-year Treasury yields were around 0.5, 0.7 around the middle of last year in 2020, and now they've kind of normalized around the 2% period, and financial modelers are kind of looking at even like breaching 2.5% over a short-term period itself. So effectively, with the 10-year bond deals in the US going up, that actually impacts EMD capital flows and portfolio flows clearly. I mean, for every, it's documented studies again, that for every for every 100 basis points in tightening in the US bond rates and the Treasury yields, you're looking at about 1.2, 1.5% decrease in the portfolios with emerging markets, and that has a huge consequence for emerging economies that are both low debt and high debt, because they rely on a lot of these capital flows to finance their their infrastructure investments and their day-to-day expenditures itself. Credit spreads are holding for the time being, which is really good. It's one of the risks that are coming through, but it's it's nowhere as exaggerated as it was during the 2007-2008 financial crisis itself. As you can see in that particular, the top right-hand corner graphic, the credit spreads in the emerging markets are increasing, but they're not of any concerns at this particular point in time. And similarly, you're looking at the 10-year treasury yields. There is a lot of the Fed's kind of signaling that they've got a lot of slack over there, and they're not going to impact policy. Looking at the yields in the near-term horizon itself, so they're happy for inflation to exceed its target. Oh, and this has been documented. Fed advice at the moment that they're happy for inflation to go above the long-term targets in the short and even in the medium term for an automatic readjustment to take place. So they've got it. That's kind of filtering through in terms of the credit spreads as well. They're not actually, kind of rising to the levels of concern at this particular point in time. And obviously, in terms of the exchange rate, that kind of affects all of this is, if you look at the exchange rates for the, for the emerging markets without China, there's been a lot of devaluation and a significant hit in the exchange rates itself. Now, how that filters through once demand picks up in the short to medium term is something that we have to wait and see, whether it actually kind of goes down back to the devaluation kind of reduces as portfolio flows start picking up with more vaccinations and advanced economy demand start filtering through into exchange rates for emerging markets and developing economies. Next slide, please, Lauren. Let's have a quick look at the UK economy as well, and what are the prospects governing the UK economy. Next slide, please, Lauren. So I thought I'll give you a quick whistle-tour stop of what the key indicators are showing at the moment. And we'll put some context around this as well. The employment rate at the moment is about, about a percentage point less than previous year. It's been supported to a great extent by our Chancellor's furlough scheme and some of the support schemes that have been floated by the UK government. That's holding employment rate at a particular level at that moment. What's going to happen once the furlough is slowly tapered out and the CRGH program is kind of withdrawn is something that we have to wait and watch, and how many of these furloughed workers would actually be, would actually have a job to go back to. The government's looking at reskilling a lot of people, so they've got a lot of projects at the moment that are looking at reskilling people, and that will help, but that's not going to feed in through the short and medium term. That is primarily going to take a little bit of time before it feeds in through the structural employment rate in the long term. Also, productivity is something that needs to be looked at in terms of UK risks. Productivity has been historically low. Now, with a lot of building back better initiatives that the government's floating, depending on how much of it actually flows through in the economy. Some of these greener economy initiatives, some of the IT, smart market kind of development that's taking place within the government itself. If those come to bear fruit, then you could look at productivity gains in the medium to short term itself. There is we are expecting productivity gains within the next year, but that's primarily because the pent-up demand over the course of the next half of the current year and the next year itself would require a lot of a lot of employment coming back in terms of some of these industries itself. But again, sectorally, it could be very divergent. Unemployment rate at the moment is 4.7. It is higher than last year, year on year, but it is expected to increase even further for this particular current year. We expecting it to peak around 6.5% by the end of this year, and then start going back down again from the beginning of next year itself, from Q1 2022. Inflation's at 2.1% at the moment. It's about a 5%, 0.5 percentage point down from previous month. This inflation figure is a little bit misleading because I think it has got a lot of, and we'll see some graphs previously that we'd seen. A lot of it is being driven by the rebound of the oil prices and the energy prices that were in the last year's figures, that had filtered in the last year's figures around the same time, 2020, because of the huge drop in the energy prices. Now that they've rebounded back, that's kind of causing the CPI headline figure to be around 2.1%. Again, we expect it to rise slightly during the course of the year because of the supply chain disruptions, because of the bottlenecks that we have. But overall, on a long-term view, we do not expect inflation to be higher than the Bank of England target for any considerable period of time. And the GDP, again, the quarter-on-quarter figures are slightly down, and that's because of the restrictions that had to be put in place. We're expecting a huge rebound on that. And the annual figures for this particular term is going to be roughly around, for this year, financial year, is going to be roughly around, anywhere between 6% upwards for a full year 2021. And that has connotations in terms of underlying employment and so on and so forth. International trade, again, international trade, exports and imports to a great extent are linked to a recovery in the UK economy. Imports especially are very sensitive to consumer demand, and as consumer demand picks up, which all of the high frequency data is kind of pointing to, that's kind of showing that imports are going to increase over the short-term period. Quarter on quarter, there was a 12% reduction in imports and an 8% reduction in exports. But again, that's for a period where your quarter-on-quarter GDP and consumption effect on GDP kind of actually fell, and that's kind of caused by that itself. The deficit narrowed a little bit to about 30 billion, but we expect that to rise in the short term. Mouth-watering debt levels, and they have to be addressed. It's one of the biggest risks that our economy faces. It's about 99.2%, but it has come down from last year, which was around 103, 104, 105% of GDP. We expect that to decrease over the course of the next 24 months as the furlough comes up and as the economy starts picking up and the tax receipts start coming in. Next slide, please, Laura. What I thought would be a good thing to do, given this particular overall scenario, is to look at the, what we did was do an average of independent forecasts coming out of the market. It's about 2025 forecasts that the Treasury also looks at, just consultancies and different economic think tanks. And we thought, let's have a look at those and kind of make you guys aware of, where, what this actually means in terms of the dynamic in the forecast itself. So so those particular dates in the slide is when the forecast actually took place. So if you look at February 20, the growth percentage and March 20 all throughout last year, what was the actual GDP growth percent forecasts, and what is it now. So the latest figures, if you take an average of the May 21 forecast, it's around 6.5% in 2021. Maybe just a little bit less than that. We have a range anywhere between 7.2 and 5.5 within those particular independent forecasts itself. We are expecting the UK economy to recover to its pre-crisis levels by Q1 2022, and depending on how swift the bounce back is, it could actually do that in Q4 2021. As well. Growth's going to be tapering off slightly, but not to the long-term averages. It's still going to be quite high next year, around the 4.5 to 5% mark. Again, if you look at it, it kind of tells you how the actual sentiment and how the predictions have actually moved over time. We expect most of the sectors to return to growth by 2021, although at uneven rates, and we think that the travel industry might still be suffering a little bit till about Q1, Q2 2022 because of the uncertainty around the pandemic, and it depends on how government policies pan out, not only in the UK but also overseas as well. Household spending and government consumption is going to is going to drive growth this year. There's a lot of pent-up demand, and the government's putting in a lot of infrastructure investments and community investment that is going to drive government expenditure this particular year itself. Hopefully, it's going to result in productivity increases and so on and so forth over a period of time. But there is a lot of government consumption that's actually taking place, primarily in infrastructure investment over the course of the next 2 to 3 years itself on this planning cycle. The main risk to all of this is obviously the virus. If we end up having a mutant strain which then derails the entire recovery plan, then, or escapes the vaccine, then we've got an issue on our hands and we're back to square one. Next slide, please, Lauren. Inflation outlook. The Monetary Policy Committee is, we're expecting them to be quite relaxed about exceeding their MPC targets in the short run. Again, a lot of that short run is inflation numbers are coming through because of energy prices at the moment and because of supply chain issues and bottlenecks that we expect are going to be resolved over the next 6 to 12 months. So inflation is a risk, but it's not something that we would we would be really worried about at this particular point in time. And it seems that the central banks are quite relaxed about it as well, and they're happy to kind of let inflation exceed their targets. The downside risks of that is obviously, if it becomes structural over a period of time, and if those supply chain issues become structural because of the impact of the pandemics, because of the impact of the way the global economy demand is structured and so on and so forth, because of the development in the low income countries in terms of their pandemic evolution. All of that is then going to make obviously a significant effort in terms of the government having to adjust rates then and adjusting or tightening monetary policy in an in a recovery phase is never ideal, and that would have impacts on the growth numbers that we had discussed itself. The inflation for the latter half of the year, we think, is going to be dampened slightly once the furlough is withdrawn, and that results in unemployment, and that could obviously unemployment numbers would feed through into wage growth numbers itself, and that could actually have an impact on inflation slightly in the latter half of the year and primarily going into 2022. We think that inflation is going to return back under the MPC target itself. Overall, in the medium term, expectation is that it will settle at around 2%. Next slide, please, Lauren. Unemployment, again, we think it's going to be peaking around 6.5% at the end of 2021, once the furlough starts getting withdrawn and once the support starts coming off. We would see unemployment increase. But over time, with the pent-up demand and a lot of relocation and some reskilling of labor as well, effects might be coming through into 2022. We think unemployment numbers are going to go down by the final quarter of 2021. However, if you look at the unemployment numbers itself, they're still going to be a lot above the 3.5% of the full employment numbers that we are used to pre-pandemic, around the global financial crisis time period itself, and that's primarily because of the economic scarring that would have taken place. There is undoubtedly been a huge amount of economic scarring that has taken place. Now, how we kind of realign some of this as we build back, what are the sectors that would pick up the slack, and how easily would employment be able to be relocated, but also to a great extent productivity gains happening as a result of that, is something that we have to look at and have to wait and see. But we think earnings are going to, wage earnings are going to increase in 2021, and it's going to normalize in 2022 slightly. The relative to the pre-pandemic forecast, I think the average earnings in 2024 is still going to be about 6% lower than the trend that was being predicted. If we break that down, around 2% of that would be medium-term productivity scarring, and 1.5% would be because of lower inflation and the implications of lower inflation on a number of these businesses itself. Next slide, please. Public sector finances, obviously borrowing at and debt at record highs. I mean, we haven't seen numbers like this since the 1940s. The national debt as a percentage of GDP around 99% at the moment. It was even higher last year. It's slightly come down as the economy is starting to recover. And some of these schemes, it will go down even lower as some of these schemes start being withdrawn, and as the debt started getting paid off with public sector borrowing, net borrowing coming down over a period of time. What we need to be careful about is how we do it. If we try and act too fast, too soon, it is going to, in our opinion, it is going to have structural damages to the economy. So it is quite a fine balance of having to, weigh up the damage that is caused by withdrawing support very soon at a high breakneck speed. We just have to make sure that we avoid cliff edges. That is primarily it. A slow tapering off over a period of time would possibly be more beneficial in terms of the economic scarring that might actually result in. But also in the medium to short term itself, with the higher GDP forecast, we expect borrowing to go down a lot because of the higher tax receipts that come through, and hopefully by the end of the current planning term, the government planning term, the current parliament, that net national debt number is going to go down slightly as well. Next, next slide, please. International trade, obviously, a key component of the UK economy. Both exports and imports, and in general trade volumes have suffered as a result of the pandemic itself. Albeit in different sectoral analysis has different effects on actual trade volumes itself. But the current account deficit as a result has improved slightly, and that's primarily because of the demand component that I was talking about. The imports have gone down more than the exports, and that's kind of impacted the current account deficit itself. And that is a structural issue. I mean, obviously, as the UK economy starts recovering and there is more demand, consumption demand within the economy itself, that balance of payment number and that current account deficit is expected to increase again over a period of time. We've also had, and this is not something that I've actually included over here, but there has been a significant inflow of capital coming in to the UK as well, even post-Brexit, for FDIs and so on and so forth. And that's been, and that's kind of had an impact on stabilizing, our exchange rates to a great extent, but also that bodes well for employment and so on and so forth going forward. Nearing the end, next slide, please. Kind of conscious of time, I'm going to quickly run through some of these, the financial stability indicators itself. The greatest risk is to our entire growth outlook is obviously the financial markets tightening. If there was a liquidity crunch that developed in the short to medium term, then that would derail and would cause a lot of panic, especially in terms of the growth prospects for low income and development, EMDs itself, the emerging markets itself. As you can see in that particular financial indices graph on the left, there's a significant tightening that's happening in the United States at the moment because of the confidence in the markets over there itself, and that's leading to higher reals and higher real-term interest rates itself. Euros, within the euro area in the UK, it's less pronounced, but there are early warnings of tightening itself. And that's primarily happening because of primarily the asset bubbles that have been created as a result of loose monetary policy and the fiscal stimulus that has been happening over a period of time within the economies itself. There is a significant misalignment in the US equity market. If you look at the deviation from the fair value per unit of risk, you can see that there is, there is quite a significant deviation within the US equity market, and this is clearly because the real economy is not at par with the financial markets at this particular point in time. And we're seeing early indicators of the real interest rates and nominal interest rates climbing, along with the inflation break-even point itself, which these are all risks that are lurking at the back. At the moment, the markets seem to be quite comfortable because the spreads are not widening to the levels that would cause a concern, and the spreads, especially even in the emerging markets, are kind of holding quite strong. But how far this goes on till and how long this goes on to, if this tightening keeps happening, is anyone's guess. Next slide, please. So just to kind of sum up everything, growth projected at 5.6% in 2021 and about 4.3%. That's the global outlook at the moment. Obviously, that depends on a number of things. The strength of recovery is primarily attributable to the advanced economies, US and China, leading that. A lot of emerging markets apart from China and a lot of low-income countries are experiencing downgrades of their growth projections. The recovery is uneven, as we've discussed. What that means in terms of global poverty, poorer health outcomes, lower productivity, inequality, and all of these kind of things would have to be looked at in the long term itself. The vaccination is key again, the evolution of the pandemic, obviously, along with the vaccination, would hold the key to it. There's a renewed focus on supply chains and health infrastructures coming out of the pandemic itself to develop resilience. So a lot of countries are looking at their supply chain at the moment and kind of restructuring their supply chains, putting in more funding into their health infrastructures to deal with future pandemics and future health endemics and so on and so forth. And there seems to be a lot of focus, at least there's a lot of lip service going on around sustainable growth and carbon emissions itself. How much that bears out in reality is something that we have to look at. The risks, as I said, is primarily coming out of the pandemic itself. So any sort of mutant strains is a huge risk. Policy support easing, as I've mentioned, if you take away, turn off that tap very quickly, then that's going to lead to stability. That's going to lead to lower efficient outcomes. Primarily two themes emerging. The divergent global economic recovery and the unintended consequences of the asset market bubbles itself. That's coming out of the accommodative financial policies that are being run. Emerging markets are facing a daunting challenge, and it's not just a problem for emerging markets and low-income countries. If emerging markets do not recover adequately within a period of time, that would impact the development in advanced economies as well, and unemployment, trade, and everything that goes along with it. The corporate sector emerging through notable differences in firm sizes and sectors. So the sectoral participation rate, that sectoral impact has to be looked at, and if support's required, sector-specific support's required for the short term, that should be extended. The banks have so far not been, part of the problem, and they have continued credit going, liquidity going in the market. But if they turn around and start, getting affected by some of this tightening, and liquidity is impacted as a result of banking decisions, and credits affected, that's going to cause issues primarily for emerging markets and low-income countries, but also for developing economies as well. And as I said, finally, the ongoing support has to be continued at some level, so that we do not fall off a cliff edge at any time soon. And that is it from me. I'll hand back to Lee.
Thank you, Sagar. Everyone, I'm just conscious of time. I think we have a little bit of time for some questions. If you could post them in the Q&A, and I know some have already, so I'll run through those in a second. and we might slightly overrun for those who are able to stay on, but let's see how we get on. So the first question is, are you expecting inflation to be no higher than the Bank of England's target because of, or in the absence of changes to the base rate?
Yes, I mean, at the moment, in the short term, we are expecting all the modeling that we're doing at the moment suggests that inflation is going to be above the MPC target in the short to medium term. We are expecting inflation to go back to normalized levels around Q1, Q2 2020, 2022, probably by the end of 2021, Q4 2021, and that's primarily because some of the unemployment and wage effects are going to filter through in the latter half of this particular financial year as furlough starts tapering off, and as the economy goes through a bit of restructuring in terms of employment allocation and so on and so forth. I doubt that the Bank of England is going to move on policy rates anytime soon, even if they see a significant rise in the inflation numbers beyond their MPC targets. And I would think they've got a fair bit of slack in there. It would all depend on how the markets react, but I doubt if Bank of England would actually make any policy changes to their rates till middle of next year, probably even Q3 2022. And there's nothing in the data at the moment. There's nothing, there's no signals coming out of Bank of England to suggest that they're really worried about inflation at the moment.
Thanks, Guy. A sort of follow-on question and touches on your point around wage inflation. Why aren't you concerned about UK wage push inflation as the hospitality and leisure sectors reopen, caused by our inability post-Brexit to import labour from the EU?
Yes, that's a good point, actually. We think that any kind of wage inflation we're expecting wages to go up, but we don't think they're going to rise to the levels that would be concerning in the short to medium term itself. I think in terms of employment numbers itself, and there could be an impact if there are controls that are put on workers migrating. But I think the government's going to react if they see that coming through in the numbers, and there is a lot of policy decision that is readily available to the government to reduce that in a short to medium term basis. So given that the government can play around with immigration rules and sector specific support, if there is a tightening of or there's an increase of demand in the specific sectors itself, we would expect the government to actually step in and act. It's not as if the resource pool is any less. It's just trying to increase that particular policy decision to the levels that is required to let that immigration flow itself. So we're not overtly concerned with the wage inflation. Wages are going to go up because of short-term adjustments, but over time we think it's going to be normalizing.
Thanks, Guy. So moving on to the other very topical UK question is around the housing market, and do we think the HPI bubble will burst?
Oh, it's anyone's guess, actually. I don't want to be looking into a crystal ball at this particular point in time, but the indications are, when you look at high frequency data like mortgage approvals and everything, and the levels of debt and the tightening, and the prospects of tightening of monetary policy and so on and so forth, it's reasonable to expect the housing the housing market to always be a risk within the UK economy. Whether that actually translates into a full-blown crisis because of because of confidence just drying up, or suddenly credit becoming unavailable, is is less so. I mean, I don't think at the point the government kind of monitor the housing market data quite quite closely, but it is definitely a risk, and I can see whether there's any sort of asset bubble, whether that be in housing, whether that be in the in the rest of the asset market, equities and so on and so forth, is a significant risk for the UK economy, and it has to continue to be a risk in the short to medium term itself. The only way to kind of mitigate that is to increase supply, which is not going to happen straight away. And the issue is whether the government's kind of willing to pull back on some of these. I mean, it's already pulled back on the mortgage support to the population itself, and if they see that, they can actually, if they see the worrying numbers going into the housing market, they do have that tool of withdrawing the more numbers. I would be very reluctant to implement increased rates to curtail demand. Fiscal policy is probably the way to go around doing that.
Thanks, Sagar. Really interesting. I think one last question, actually, for me, just looking ahead, what do you feel building back better that you referred to will look like?
It's a very good question, Lee. I mean, if you look at core issues with the UK, and I'm gonna try and answer this question based on the UK economy itself, and giving a UK economy. If you look at the perpetual problems for the UK economy over the last 2-3 decades, it has been productivity, and we seem to be generating a lot of jobs in the low wage categories, in the in services that are low skilled, and that kind of obviously over time needs to be looked at. How do we increase productivity? And it is the productivity conundrum is it's a very important conundrum. It's also a very difficult conundrum to actually address. You cannot change productivity overnight. It cannot be a short term. So effectively looking at, if we've had some economic scarring as a result of the pandemic, we need to look at how can we kind of get these people back into the economy, into reskill some of these economies so they are actually, adding more value to the economy in the short to medium term, as well as in the long term itself. We have to look at our health outcomes. We have to look at our educational outcomes, but we also have to look at industries that would give us maximum value added. We can't continue to worry about, what are we going to do if this particular industry suffers as a result of us opening up? We have to be creating industries that add value at a level that would increase productivity itself. So anything in the new economy, any kind of work within the green recovery fund that is going to take place, any kind of work within the infrastructure funds that the government's allocating, if that can be well targeted, and if that can increase educational and behavioral outcomes and employment outcomes, that would be the way to kind of approach this recovery going forward.
Great, thank you, Sagar. Very insightful. I hope everyone's found that interesting and useful. Thank you very much to the audience for your very good questions. I think certainly some topics that are on people's minds, particularly around inflation and housing and how we come out of the pandemic crisis. But thank you for joining us this morning, and I wish you a good day further.
Thank you.